All right, this one hurts. This has been the worst first 2 quarters of stock market in my entire life. And if you've been investing for any amount of time, what's happening now? Well, it hurts. There's pain. The take on the first 2 quarters of this year from Charles Schwab is the market and investors are under pressure. That's an understatement.
What we got now is Brokeback Mountain!
And here's Morningstar's take with the details. The second quarter of 2022 was challenging for investors. Stocks officially fell into bear market territory. Bonds sold off too, and cryptocurrencies of all types crashed. Rising interest rates and high inflation continued to stress markets, and many market watchers began talking of a possible recession. Really? Possible? Just possible?
I feel your pain.
It's at times like this that you wonder whether your investment strategy is really worth it. Is it working? Especially in a difficult market. Heck, when the market's going up, you can throw anything at it and you'll pretty much make money. It's when it turns into a bear market that it really challenges not only our commitment to investing, but our strategy. Now, there are 2 habits that are part of surviving a bear market and building for the future in your investments. 2 habits that have never been more important, and that is DRIP and DCA. Hi, I'm James Callahan, and this is the Do-Over Show, where we started an investment project back in April of 2020. Open up a Roth IRA, max it out annually, and see what we can do. Well, in a market like this, especially in a do-over when it comes to our money, bear markets, they feel like we are being doubly punished because we blew it the first time and we're starting over, and then another bear market hits us and we wonder if we will ever get out of the hole that we dug for ourselves. That's why DCA and DRIP are important habits to maintain and to encourage in difficult or bear markets. Now, DCA is dollar cost average. Let me give you an example. For this Roth IRA, I invest 1/12 of the max annual contribution every month. That's $583.30. And I put it in, deposit it at the beginning of the month 12 times a year. That gets my $7,000 annual contribution to the max. Now, in those first few days of the month, whether the market's up, down, or sideways, I invest in 2 handfuls of stocks, 10, 11 different stocks that I've maintained from the beginning, lost one when it was bought out, but added another, and added another one in the second quarter this year, Coca-Cola. And I buy incrementally in each of the stocks. That, in a nutshell, is dollar cost averaging. The hard part of it is when the market is down to pull the trigger and to actually put more money into things that are in the red. Here's the interesting thing. Since I started this project in April of 2020, remember what happened in March of 2020? Everything crashed. Now, since that time, everything has been going up. Well, until this year, when things, for the first time in this investment account, some of my positions are in the red. Yeah, even after the DRIP, which we'll get to in a second, even after that, some of my positions are now at break even or in the red. Now, when that happens and you're dollar cost averaging, it's really the best time to invest. Why is it the best time to invest when things are down? Not just because they're on sale, but because when your positions are up 20, 30, 50%, like some positions have been over the past couple years, and you add to those positions, you are actually raising your cost basis for each position. And for dividend paying stocks, that means a lower dividend is offered per the dollar amount you've invested. I find it more difficult to invest in these projects, in this project, when the market is continually up. And lately, it's never been better to dollar cost average. Now, there are studies, I've done a video that you can check out about dividend investing and dollar cost averaging, check it out here, that actually tell us that when we dollar cost average on a consistent basis over a long period of time, we do better than people that try to time the market. You're not going to pick the bottoms and call the tops in every market. That means that dollar cost averaging takes that guesswork out of it. You're not smart enough. I'm not smart enough. Most hedge fund managers are not smart enough. The difference, though, is that when we put money in on a regular basis, regardless of whether the market's up, down, or sideways, we give ourselves the benefit of time in the market rather than timing the market. Now, the other acronym I mentioned is DRIP, Dividend Reinvestment Program. And you can have a setting like I do on TD Ameritrade for all of my positions that pay dividend, that when the dividend is distributed, when it comes into my account, It automatically buys those shares or fractional shares of the positions from which the dividend came. And you can do it on other accounts like Robinhood. But what it does is it automatically reinvests the dividend that you received, say from Walgreens, Boots Alliance. You get a dividend quarterly and you buy that amount in shares, full shares or fractional shares, so that you continue to build the size of the position. And that means that in a down market or a bear market like now, that means that, well, we're actually getting a better deal. When some of my positions are actually in the red or at break even, well, I don't feel so bad about buying more because I bought it with a good intention at a good price in the first place, and I get to buy more at the same price. For the positions that have gone up 20, 30, and 40%, it is more difficult to just voluntarily raise the cost basis of each position. Now, here's how DRIP works. It's not just that you don't touch the money. It's that you build position size. And that's the key to being, well, not diversified, that is, overly diversified. Sometimes we throw everything at everything, hoping that something will win. That's how to maintain or hold on to your money, not how to grow it. One of the keys to smart investing that everyone from Charlie Munger and Warren Buffett have taught us is that you've got to focus on certain areas. You concentrate in order to build wealth. You diversify in order to maintain wealth. That's another good motto to keep in mind in a bear market. So let's look at the numbers. As of the end of the second quarter of this year, the account has a value of about $19,800. Now, of that, I've made contributions of $17,450 with my dollar cost averaging monthly since I began in April of 2020. That means that I have not only dividend reinvestments, but profits of about $2,300. The positions I have in the account, well, it includes Apple, Associated Bank Corp, B&G Foods, Duke Energy, Iron Mountain, Coca-Cola, a new position, Altria, Realty Income Corp, Pfizer, Simon Property Group, Presidio Property Trust, Ph.D, which is the Invesco S&P 500 high dividend, low volatility fund, as well as Walgreens Boots Alliance. Now, one of the interesting things you can do on platforms like TD Ameritrade is to get an income estimator from your positions and what you hold now, and you can get an average yield annually and an average payout. So I'm at about 4.85% of dividend income on my investment annually. And that means that right now I receive $1,065 every year from my dividend reinvestments in this account. That is beyond anything that the stock performance will yield me. The value stocks yield those dividends, and that's the predominant makeup of this account. Now, there's one last feature of what this project is supposed to be teaching me and what I'm supposed to be learning, and that is not just DRIP and dollar cost averaging, but to learn how to endure even bear markets. Now, like I said, I'm still up, even though the markets are down considerably, 10, 20, 30%. And some of those stocks that we invest in, especially tech stocks, have been hit very hard by the rising dollar. And their bottom line is hurt when the dollar is high. And the dollar is high. In a market like we're in today, having this consistent commitment to dollar cost averaging and dividend reinvestment is really the best time to double down on this strategy, to hold to it. We're too tempted, especially in do-overs, when something doesn't work overnight, we're too tempted just to try something else. Well, that didn't work, and that didn't work, and that didn't work. Remember that the problems that got us to the point where we needed a do-over, they didn't happen overnight. And the correction to them is not going to happen overnight either, especially when it comes to how we handle and how we feel about our money. Now, I also have to add this disclaimer. I am not a financial advisor. This is not financial advice. This is for educational purposes only. But even though I talk to financial advisors, they tell me exactly the same thing. I'm just passing along the hints, the tidbits that they give us. But these things that we are to commit to, this consistency, this dollar cost averaging, they're very important in a tough market like we have today. So hey, tell me in the comments below your investing project. Are you up, down, break even for the first 2 quarters of the year? How does it feel to invest in a bear market? And are you really committed to staying in the market and spending time in the market rather than just trying to time the market? And if you're smart enough to time the market, could you drop in a comment about what makes you so smart? And thanks for being part of the Do-Over Show. Please, could you tap the like button because it really helps, and while you're there, consider subscribing and ringing the notifications bell so you don't miss an episode. I'm so glad you found me, and I found you. Thanks.